Hey, what's up, guys? Welcome to my YouTube channel. What we're going to talk about is Ripple, a little bit of cryptocurrency, and why options do better than crypto. Ooh, yeah, I just offended some of you. It's all gravy. But I'm going to back it up like a Tonka truck with evidence and with data. So let's take a look, right? Everyone on social media right now is talking about, see, look at that. We got some viewers that left. See, I told you. Ripple. Very, very nice day yesterday. Let's take a brief look at it. So apparently, now this is just from what I hear, okay? Apparently, they won a court case and the judge or the whatever said that Ripple is not a security. All right, cool. So upon that news, and I wonder why price was in consolidation before that. So we see Ripple's close at 47 cents roughly. And yesterday it rallied about 100% up to about 94 cents. Okay, great. It doubled essentially. Now it's pulling back a little bit today. It's about 55% from yesterday. Look, I'm not going to argue those are good numbers. Anybody can agree those are good numbers, right? I get it. And I would never argue that. But now let's come back for a second. That opportunity happened how many times in the last couple years? Well, a few. But let's say 2023. Let's say this year, it doubled in a day once. Maybe a couple times if I check my math, because I really don't look at Ripple all that much. Okay. So one day, it did double. Props. You have my respect there. However, if you go into the Nasdaq right now, if you go into the triple Qs, if you shorted in here, where price is at right now, it's up 70, 80% in an hour and a half. So options do this shit every day, whereas crypto, not all that much. Let's take a look, pull up the options prices. Let's see, this would be a 380 put. All right, so this is delayed a little bit. This right now has a high of 174 here in the afternoon. So we went from $1 during lunch. It went to $1.74 here at the high. So that is a gain of what? 74%. Now this happens every single day. Whereas Ripple once this year. You guys asked me why I trade options and why I don't really ride the hype of crypto, because this is why. You want to see double digit, triple digit gains, options market. So here's a visual representation of what it looks like when Friday can be anticipated as a down day or as a reversal day. Now, I used to teach this many years ago, the concept where if Tuesday, Wednesday, and Thursday are up days, then Friday can likely be a down day. Now, that by itself is not going to do the greatest good for you. If there are higher time frame things in mind, that's going to help you. And also, if Monday is part of that consecutive up movement, then I think that will contribute to the probabilities that Friday will be a down day. Now, as a label for this, I used to call it a profit-taking day. And this same idea can be inverted, where if Monday, Tuesday, Wednesday, Thursday are down days, then Friday could likely be an up day. And I used to, again, consider that a profit-taking day, because the idea is if Monday through Thursday is down and Friday's an up day, then to me, that's like short covering before the weekend, to give a little bit of context as to why the market would do that. Now, of course, when you ring in other factors like higher time frame concepts or even intraday or higher time frame relative strength, things like seasonality, stuff like that, then yeah, you're going to have a higher probability setup. But just the concept itself in a visual representation, this is what it looks like. Okay, so again, the market would trade higher all week, and then Friday could be a down day. So Friday, I would be looking for reversals. So You can easily see two examples on this chart. Number one is last week, and I'll highlight that here, where you can highlight Monday, July 10th was an up day, Tuesday was an up day, Wednesday gapped higher and closed higher, Thursday gapped higher and closed higher. So Friday, it actually gapped up and rallied first. And that's why I was looking for shorts on Friday. That's why I was looking to short the triple Qs with an options contract. And there it is. You can see another example over in here where you have Monday, June 12th was an up day. Tuesday was, it looks like a doji almost, or like a flat close rather, but it still gapped higher, came down, filled the gap, and then rallied. So I'd probably still consider that an up day. It's still considered a gain. Wednesday was an up day. Thursday, it did gap down, but it still closed higher. So that's an up day. And then Friday, June 16th was a down day. So that Friday probably would have been okay for looking for shorts. Okay. So here's just two easy examples. Now, it doesn't always happen like this because, I mean, it's very specific. You need either Tuesday, Wednesday, Thursday to all be higher, or Monday through Thursday to all be up days. And then Friday could be considered a down day. Now, if you do enough back testing, I'm sure you'll find a scenario where all the days were up and, you know, it wouldn't have worked. So this isn't going to be a strategy that's 100% win rate. And you guys already know that no strategy is going to have a 100% win rate. But again, just to show you some examples, at least on the triple Qs, here they are. So now we'll drop down to a 15-minute time frame and we'll look at an intraday basis for Friday, July 14th. So here is Thursday's close. All right, little down candle here. And then here is Friday's open. So you see how we gapped higher right here? We gapped higher and then continued to rally. So to me, that just entices buyers. It entices buying, or maybe they're trying to long this retracement. But as soon as this market retraced higher, I'm actually shorting in here. So it wasn't really anything all that fancy to me. It was a 15-minute imbalance here. This is also a classic fractal high. Whether it's a 3-bar or a 5-bar pattern, that's still a fractal high here. Okay, so again, if Friday is anticipated to be a down day, then if the high has been set, hopefully, because I was not one in the market traded this high, so that was pretty much where my stop was at. So we traded up into this imbalance. I shorted. I spent a little bit of time in drawdown. So the option contract, it did go against me for a little bit. I paid 120 and then it went down to about 96. So I mean, you know, I was in a little bit of drawdown, but then we ended up going lower, spent a little bit of time just hanging around in this area. And then right near the end of the day, especially in that final hour, we traded well below that 380 strike price. So again, the strike price for the contract was 380. So that was right here. So that is the price that I needed the contract to trade below, ideally. I mean, I could have gotten out before it got to 380 with a profit, sure, but I figured the market would actually trade beyond Thursday's close. I wanted it to fill that gap and some. Plus, there's actually another imbalance down here as well, at least on the triple Qs. You look at it right here. It did trade into that. It didn't really respect it to a high degree, but still a good exit right around that 2 o'clock, right at the beginning of that last hour of the stock exchange. So when your contract is OTM, OTM means out of the money, right? It's based on the calculations, however it's done, I don't know entirely, but I know that based off the calculations, since that contract is out of the money, it's considered unlikely to expire in the money. So the contracts are considered cheap. And when they get into the money, now it's below 380. That put option, right, is below 380. So now I believe the contract, you know, is worth a lot more. And so I'll show you a visual representation in just a minute, but right up in here, when you're able to short in this area, okay, again, I paid $120 I only bought one contract, one put option for $120. And by the time it traded down here, I closed it. I actually had a limit order when we got really close to it. And it was filled at $250. Okay, so that is a gain of $130 profit, right, per contract. I only traded one. I wanted to keep it realistic for you guys. And that is more than 100% gain. Okay, it's about 109% total where I got in and where I got out. So even with not a good entry, I didn't get the ideal entry because remember that option contract went down to $96. So I was in a little bit of drawdown. But if I had got it at 100 to 250, that's really good percentage. So either way, there was the entry on the way up into this imbalance, and then a little bit of drawdown, holding it to the end of the day and getting rid of it before the close of the weekend. Right. So above 380, it would be out of the money, which means it would expire worthless if I held it to the contract expiry. And below 380, it's worth a lot more than what we paid for it, especially now that it's in the money. And then you also get a volatility factor, I'm sure. I don't know all the Greeks and exactly what they mean. I'm not an options expert. I would never claim to be an options expert, but I know that when the market is more volatile, the options can definitely dance a little bit and really, take that option home. So again, paying $120 per put option and then selling it in the afternoon for $250 per option. And next, I'll show you the barchart.com chart that gives you a visual representation of the put option, what it would cost, and how much you could sell it for. All right, so just like in the thumbnail, yes, the thumbnail is an actual chart, okay, minus the space guy. This is the QQQ July 17th, $380 strike price put option. Again, barchart.com. So when you look at the numbers here, you got to remember that an option contract is the right but not the obligation to either buy or sell 100 shares of whatever. So even though it says $1, you have to multiply this price times 100 in order to get what it would cost per contract. So like I mentioned earlier, that $1 down here, so when price is right here, that means it would cost 100 US dollars per contract. Now, I didn't have the greatest entry, so my entry was at 120, so I paid $120. That must have been right in here because again, I had taken a little bit of drawdown in here. I went down to 96, I believe, when I was watching it. But then you can see easily by the afternoon, it went right up here, right in between 240 and 260 would be 250. Okay, so I was exiting right there, right close to the high, right up in there, right? Buy low, sell high is the name of the game, right? So just in case you're confused, guys, you have to remember a put option means we want the price of that asset to go down. So when the Nasdaq is going down or the triple Qs are going down, our option contract is going to gain value. So the chart of the value of the option is going to be an inverse to the stock since this is a put option. Okay. So as Nasdaq is dropping, our contract is increasing in value. So you can see the turning points when the Nasdaq topped, retraced, consolidated, and then it dumped at the end of the day. You see that option contract really increasing in price. So if you look at it, right, and this is what makes options a little bit tricky sometimes or a little bit weird sometimes, because when you look at the value here between 1300 and about 1420 Eastern, price doesn't really do a whole lot. It goes from around 140 to 180 and then chills between 140 and 160 for quite a bit of time. Then we get a little bit of a premium up to $2. Then it drops back down to about $1.65, maybe $1.70. but then all of a sudden it quickly runs from $1.80 all the way up to 250. So this to me, that's that volatility that we were seeing in the triple Qs. Okay. And that's when options is fun, because you get to see such massive gains in a short period of time. So from $1 to $2, that would be doubling your money, or $1.20 to 240, that would also be doubling your money. So essentially you could double your money even not getting the greatest of entries. But just like I said at the beginning, be careful. Options can really rip your face off. It can do you some damage. So don't trade with money you can't afford to lose. Okay. I really want to be clear on that. Even though the title says and the video says you can double your money, you can, but you can also really, really get burned as well. So just make sure you're well aware of the risks and the rewards too. All right. And that's going to be the end of this video. So hopefully you guys learned something. I thank you guys for being here. If you got some value, please do me a favor and drop a like. It would mean the world to me. Thank you guys so much. And I will see you in the next one.